several other, thank you. There will be several other sorors joining, but want to be mindful of time. So the agenda for this evening is that I'm going to kick off with a welcome and a thank you. This is brought to you by the Economic Development Committee. It is a chapter only workshop. So this is just us, family, virtually getting together to talk about some financial topics. I wanted to also tee up the Financial Fortitude Challenge. So part of this workshop is that we are also kicking off the Financial Fortitude Challenge. So I'm going to spend just a moment recapping that challenge. I shared this also during chapter meeting, but I also want to kind of reiterate some of the points. And then I'm going to get right into introducing our speaker and setting the stage for the rest of the event. So let me share my screen and remind everyone of the challenge. So Soror, starting now, starting today, starting this month, by the end of this month, we are asking everyone, if you are interested, to join us, which you are, at the Financial Fortitude Workshop, but also participate in the Financial Fortitude Challenge. So what that will entail is you will receive an email, and that email will show you the list of tasks and challenges. We're asking sorors to review that list, and a lot of those tasks, all of the tasks and challenges, we will touch on those topics throughout this evening. And for every task that you complete, there's going to be a certain number of points associated to that task. And I'll share what that challenge, I share a checklist with you so you can see the different tasks. And the soror with the most points from all three sort of categories that we have, dolls, divas, and dears, will each win a $50 gift card. And so if there is a tie and we are very competitive, then a soror will be drawn at random out of that specific bucket of sorors. And then we're also going to match. So there's going to be points associated to the challenge. And if we get up to 300 points accumulated, we're going to match that and donate $300 to Stand By Me. So the challenge runs through April 15th, and April is Financial Literacy Month. So all of this is really done to just lead up to Financial Literacy Month. And then the winners, each soror will be announced at the May chapter meeting. This is an example that will be sent via email just of the checklist. So the idea is that in the email, you will receive this checklist, something that you can either print out or you can refer to. And when you're ready and you're done, there's a link where you can link directly to the Google form to actually kind of say, these are the ones that I've done. And then we will accumulate your points accordingly. So you can see it's a lot of common financial related things, ranging from, debt management and savings. I think someone is unmuted. To creating wills, funeral planning, and legacy planning as well. So just wanted to tee that up, sorors, for everybody to tie that, bring that connection of what we're doing throughout this month leading up to financial literacy. I would also say, before I introduce the speaker, this is meant to be casual. So we want and encourage you to ask questions. You can either unmute yourself and say, Soror, I have a question. Soror Jocelyn, I have a question. You can put a message into the chat box. You can use a reaction to raise your hand, but it is okay to interject. So we want this to be just a dialogue amongst sisters and family in our chapter as part of this workshop. Was everyone able to see my screen? I got a message from technology. You said reshare your screen. Did that go through okay? Sorry, I didn't see your message, Stephanie.
We could not see the checklist that you were talking to.
Ah, got it. That's right. Okay, 1 second. That's because I did one document. Thank you. This is the checklist. Thank you. So this is what will be in your inboxes soon. It ranges, you know, again, this is just meant for you to kind of have a cheat sheet, but you can link directly from here to the Google form to submit your the items that you completed. Thank you, Stephanie. Okay, so I am going to introduce Jocelyn, Jocelyn Wright. So Jocelyn D. Wright is an advisor who partners with her clients to create a strategy to help them make smart choices about their money in order to reach their financial goals. With nearly 30 years of financial services experience, she has been working with individual clients since 2002. Jocelyn holds the Certified Financial Planner and Retirement Income Certified Professional designations. She received a BS in Business Administration Finance from the University of Delaware and earned her MBA in Finance at Howard University, graduating with Beta Gamma Sigma honors. Some of her memberships include Delta Sigma Theta Sorority Incorporated, currently part of Philadelphia Alumni Chapter, Financial Planning Association, and the Association for African American Financial Advisors. Jocelyn serves on the boards of the Foundation for Financial Planning and Change, Create, Transform. She was recognized by Investment News in 2016 as one of the 20 most influential women to watch. And in 2020, she was nominated for the first annual Association of African American Financial Advisors 50 Under 50 program. Jocelyn is a financial literacy advocate and speaker. She is also a frequent guest on Good Day Philadelphia. Born and raised in Philadelphia, PA, Jocelyn quite naturally is a huge sports fan. She enjoys traveling, good food, and great company. In 2018, Jocelyn completed the 50 States Challenge, where she ran a half marathon in each state plus DC. So Sorors, I welcome and present and introduce to you, and we'll turn it over to Jocelyn Wright.
Hi, good evening, Sorors. I am happy to be with you. I know we have a lot to cover tonight. And as LaShawn said, this is meant to be interactive. I'm not, teaching. This is more of a conversation. So if you have a question, please feel free to type it in the chat or come off mute and ask the question. If it's something that I will get to later on in the presentation, I'll say that. Otherwise, we'll go through and answer that. I found that a lot of times your questions lead to other questions and just help to create that dialogue between the group. So I'm going to share my screen and we will get started. Give me just a second. Okay, so LaShawn already did that part in terms of introducing me. And also I didn't put the disclaimer on here, but as a disclaimer, this is not intended to be any financial advice. This is for discussion purposes only. So please consult with your personal financial advisor before making any decisions. So first, we're going to have a poll question. I want to get a sense of who's in the room. So, I know there are dolls, divas, and dears. So all of the various generations are listed here. So there will be a poll. So please let me know who's here and select what generation you are in. Who's represented? Just about another second or so for everyone to answer. All right, so it seems that we have the largest group being boomers and followed by Gen X, my generation. So great, that's good to know. So what we'll talk about, issues that are pertinent to each of the generations, but I just wanted to get a sense of who was here. So let's go into it. One of the things that I wanted to share is there was research done that talked about what are some of the top 5 financial priorities for each of the generations. Now, the generations that they focus on were boomers, Gen X, and millennials. And so these are the top 5 financial goals that each of those groups had. For millennials, these are individuals born from 1981 to 1999. And their top goal was savings. And as we'll discuss, this is important because they're just starting out in their careers and, looking at what their situation is, starting jobs. So savings is their top priority, followed by reducing debt. And this debt largely consists of student loan debt. As we know, student loan debt is a serious problem in our country. And so particularly African-American students and African-American women have larger amounts of debt than the other groups. And so this is something important that they are focused on. Saving for retirement is third. Again, they are just starting out, and that is not as high a priority as the other 2 items, but it is something that is on their radar. Followed by having enough insurance, and this could be various types of insurance. So if it's life insurance, primarily is what this was focused on. And we'll talk about all of the different types of insurance as well. And then buying a home is 5th on the list. Next, looking at Gen X. So this is my generation, those born between 1965 and 1980. And I always point out, for some reason, Gen X, we always get gypped. There are only 15 years in between here, where the other generations, there were 19 to 20. So, that's latchkey kids, not as much time, but it's all good. The top priority for Gen X is reducing debt, and this can consist of student loan debt, consumer debt, housing debt as well. So there are different types of debt that will be focused on here. Then followed by saving for retirement. Depending on when they were born during this period, they could be, approaching their peak earning years and looking at retirement. So this is a high priority. General savings, making sure that they have enough set aside in the event of emergency or an opportunity, and not necessarily designated specifically for retirement. Next would be paying off their children's education. So, they're in this age group, they have children that are in college. And so what can they contribute to make sure that their children are not saddled with a lot of student loan debt when they graduate? And then last is having enough insurance. And for our boomers, those born between 1946 to 1964, their top priority is saving for retirement. So they may be very close, looking at retirement options, and some are already in retirement. So this is an important priority for them, followed by reducing debt. There are still some boomers who even have student loan debt that they are repaying. So this is a priority, as well as paying off their home or any consumer debt that they might have. General savings, followed by having enough insurance, and then lastly, paying for their children or their grandchildren's education. And as you can see, the priorities are pretty much the same across the board. It's just, what level they are. And that's really important to point out as well. As we go through life, our priorities will change. But in a lot of cases, as you can see here, they're really consistent in terms of the categories. So next, what I want to talk to is just kind of level set now that we have some information about what are some of the top priorities for the various generations, is talking about just how we relate to money and the difference between men and women when it comes to money. Many of you have heard of, men are from Mars, women are from Venus, but when it comes to money, there is a different mentality and socialization that we have. And I just want to point out a few that are included here in this slide that I think are very important. The second one is men are socialized to learn how to invest and make their money grow. It's almost like a game to them in many cases. Whereas for women, we are socialized to, save money, to have it just in case something happens so that we can take care of ourselves. And these are areas where we need to change that mindset and really make sure that women, our daughters, nieces, women that we come in contact, our sister friends, are much more comfortable talking about money and, don't feel intimidated by it. Men are use money to keep score, whereas women, we use it to take care of others. And these are generalizations. It may or may not apply to you, but generally speaking, when it comes to taking risk, men take investment risk and are seen as, risk seekers in some cases, whereas women are seen as risk averse. There's a colleague of mine who likes to say women are more risk aware, meaning that once we get all the information and our questions are answered about a particular investment, we will then make that selection and not, go and trade in and out of a particular investment. But we just want to be very clear that we have all the information to make an educated decision. Men spend money on themselves and women spend money on those that we care about. And this one is important, is that men ask for what they want, and women, we ask for what we think we deserve. And in many cases, those things do not equate to, being adequately paid for those things. And lastly, men gravitate toward high-paying jobs, and women gravitate toward helping professions. So professions that are known as pink-collar jobs. Teachers, nurses, those sorts of things. And in many cases, they do not pay as much as others. I see a hand raised. Danita, is there a question?
Is this a survey of all men, or is this specific to men of color and women of color?
Well, this was done in a book that was entitled Nice Girls Don't Get Rich. So it was more than likely, it was probably made up more of not men of color. But, this is, again, a generalization. The next poll question is just to test your understanding, as we were talking about women, asking for what they think they deserve. Is women earn what to every dollar earned by men? If you would take a moment and answer this question. Give it another couple of seconds. Okay, so, all right, so the top response was 75 cents. I guess I'm sharing good news that actually now women earn 82 cents to every dollar earned by men, but I'll say that with the caveat, and we'll discuss exactly what that means. That's women overall in general, but we'll talk more about that. So when we're talking, and the reason why I put this up is we're talking about pay inequity. And so this is the information for Equal Pay Day. And this is something that we talk a lot about, particularly in my profession, is that women, we know that we don't earn as much as men do. And so it's important, as we look at it from a deeper level, that women of color earn even less than the average woman. So as you can see from this slide, that AAPI women, Asian American Pacific Islanders, earn 85 cents to the man's dollar. And what the dates imply is that this is how long a woman has to work into the year in order to earn the equivalent of what the average man earned in the prior year. So women, all women, that 82 cents, you have to work, last year worked until March 24th to earn what the average man earned in 2020. And as we go further down, you see Black women earned 63 cents to the average man and had to work until August 3rd of last year to equal what they earned in 2020. And then Native American and Latina women, that's even less. So when you think of that inequality in pay, and there are a number of reasons behind that. One is, working in those majority working in those pink collar professions that pay less, but also we know that in many cases, women, we don't negotiate for salaries. We think that if we get an offer, again, these are generalizations, that we're going to be offered a fair pay. And so we don't counter and go back. But it's important that we start having these conversations, because sometimes men will just counter an offer just for the sport of it, just to say that I didn't take the first offer. And so we're not socialized to have these conversations and to negotiate, but it's really important that we, unlearn those things, and especially teaching our young sisters that it's important that they negotiate, one, learning what the relevant salaries are and making sure that we're getting paid for our service. And the impact of this is significant. So this slide shows that over a 40-year career, how much that pay inequality is impacting us. So for Black women, it's nearly $1 million that we are leaving on the table because of that inequality. And for Native American and Latina women, it is even more. So this is really an issue that we have to focus on and be more mindful of in our careers. So this last, before we get into talking more deeply about it, I have another poll question. I'm going to ask this question twice. So I'm going to ask it now, and then when we finish, I want to ask you again. So if you would answer the question, how would you rate your current financial health on a scale of 1 to 5? 1 being the highest and 5 being the lowest. And, again, this stays here. So, please just answer honestly. Okay. So it looks like, based on the responses, that the majority of the people are somewhere in the middle. And that's a good, starting point for us to have this conversation. One of the things that I like to, have people think about is, what's your money story? We know that money is a very personal thing. When I talk to people, depending on how they were, their family situation when they were coming up will dictate a lot of times how they deal with money. If they, were in a working family home that, didn't have much, then they may be, more tight with their money. Or because of that, they may be more willing to spend because they feel that they're making up for what they didn't have when they were growing up. So it's really important that you know and recognize your money story, because that's going to be an indication of how you spend and relate to money. And so this is what's called sort of the financial money personality types. And just take a moment to review them and see which one you more closely identify with. And this is, there's no right and wrong. It's just where you are to know. It ranges from, someone who is a debtor, they borrow money for major purchases and they view money as a tool for leverage, down to the hoarder. They feel their fear of financial loss, and they enjoy keeping track and analyzing their finances. So, just take a moment and just, kind of note where you fall in this financial personality type. All right, so when it comes to our financial health, what we're going to go through is, just looking at all of the areas that we need to be mindful of and how they impact us. So the first thing is we always start off with cash, because cash is king, as they say, or in our case, cash is queen. And we want to know what's coming and going out of our household. So this is going to be very important. Knowing starting off with what do you earn, and then looking at what are your expenses. Are you living within your means? And in some cases, hopefully below your means, so that you're able to, that you're not spending and living paycheck to paycheck. And with that, it starts with creating a budget. And, that budget is really saying how you're managing your finances. So writing down, or if you're using an app or software, finding out what your expenses are. And, seeing where you might be able to cut expenses and making sure that you're put your savings to work. And I always say that this is important. A budget isn't just for people who may think they don't earn a lot of money. A budget is for anyone, regardless of what your income is, because I know a lot of people that make good money, as they say, or a lot of money, and they spend a lot of money. So they may be in a worse financial situation, cash flow wise, than someone who may not earn as much, because they're very diligent in being mindful of where their money is going. So as the line at the bottom says, it's not what you make, it's what you keep. And so that's important. We all know stories of, people who we perceive to be rich and famous who died, and we found out that they were in debt and were not managing their money properly for whatever reason. And so this is a cash flow worksheet that starts off with, putting down what you're spending in each of those categories. And so this is a good way to find out, are you spending more? So at that bottom right, you see it says cash surplus or deficit. Where is your money going? One of my first mentors when I started in the business would always say, if you look at a person's checkbook, it will tell you what their priorities are. Now, of course, we don't do, write checks like we used to, but, just see where their spending is going. That will tell you a lot about a person. And so it's very important that we know where our money is going. And I use this as an example, really just as a, for you to look at where you should be allocating your dollars. This is not a hard and fast rule. This is just a guide for people who are looking to put their budget together. How much should I be spending in each of those categories? So this is after taxes, what you should spend in each of those areas. And as you can see, after taxes, your largest category is more than likely housing. Now, some people, they may not have something in different areas. Say, for instance, I don't have children, so I don't have anything in dependent care. That money can be allocated to a different area. So it may be different for you as well. If you don't have any debt, that amount can be reallocated somewhere else. So again, this is just a guide. And so as an example, this just shows you, if you had 50,000 net income, just to make the calculation simple, how much should you be spending in each of those areas? And that will help you then to start putting your budget together. Next, we want to talk about having.
Soror, Jocelyn, someone asked, is it possible to get a copy of the cash flow worksheet?
Absolutely, I can send that. I can email that to you, LaShawn. And any of the other worksheets that are included, I can send those to you. So the next thing is looking at our savings, or what I call the e-reserve or opportunity fund. Some people call this your emergency fund. And we know, particularly over the last 2 years with COVID, how important having that emergency reserve was. And typically that's 3 to 6 months of your living expenses that you have set aside in a liquid account. So in a bank account that you can get to easily without, incurring any fees or penalties for accessing that. And a lot of people, the reason I say e-reserve is because I don't want that to be considered something negative or a bad thing. as I said, it can also be an opportunity fund. Maybe someone comes to you with, a business idea or something that you can, bless someone else or help to celebrate someone. It's not always a negative thing that you have to use the money in your savings for. So it's important that when we look at our budget, that we actually have a line item for savings, because otherwise we're going to spend whatever, and then what's left over, we'll say, oh, well, maybe I'll save this. So it's important that we actually have a line item for savings. And I'm sure many of you have heard the saying, pay yourself first. So, what comes to the house first, as soon as you get paid, making sure that you're putting money aside for yourself in savings is very important. Now, debt management, this I could, talk about just on this one topic alone, but we're just going to spend a little bit of time, a few minutes talking about this. This is, important because we want to make sure that we are not overburdened with debt. And this debt can include housing debt, student loan debt, consumer debt, all of those things. And we know that that debt also impacts our credit. So it's important that we're managing that debt effectively. There are some people who, kind of do that no debt lifestyle. And if that's you, that's great. But we know that most people have to have, use debt in a way, hopefully leveraging it to be able to buy a home or go to, get an education, do different things. So it's not always a bad thing, but we want to make sure that we're managing it properly. And we have a debt worksheet to help you see that, to really see all in one place, what do you have and who do you owe? And the reason why we have all of these various categories is because, some of your debt may have different priorities. So I have people put their interest rate, the due date, what their credit limit is, the minimum payments, as well as what they're actually paying, if they're paying more than that, and then their balance. And then the last column is the usage rate. And that's important for number of reasons. That typically, if you're having with your credit cards, the revolving debt, if you have a usage rate over 30%, that begins to impact your credit score if you're not paying the balance off each month. So that's just there for you to see, okay, I need to be mindful of this. And, if I'm looking to, go out and acquire any credit, that may have an impact on my score. And I always tell people, before you go to make any major purchases, a car, a home, to make sure that you look at your credit report and your score to know and be, armed with that information, that if you have an A+ rate, that they're giving you A+ offerings on that, because there have been many cases where, we go in and we're subjected to, higher rates than we should actually be receiving. So if you remember, during the 2008 Great Recession, a lot of Black folks were given subprime loans, even when they didn't have subprime credit scores. And so knowledge is certainly power, and we want to make sure that we know what's going on here. And for a lot of young people, so for our dolls, a lot of probably what your debt is going to be is student loan debt at this point. And so you want to look at how do you best pay that down where it makes sense, where you don't feel like you're almost paying a house note for your student loan debt. So here you can look at ways of if it might make sense to consolidate, or do a different type of repayment. So it could be a repayment based on your income that will adjust as your income increases, so you're not paying as much now. And that's important. Or if you have a lot of high interest debt for other people, how can you possibly, talk to the lenders to see if you can reduce your interest rates, would then impact what you're paying as well. So the cost of debt is going to be important. And the reason why I have the due date there as well is because I've seen a lot of situations where people are late on some of their bills, not because they don't have the money, but it's just because, they may get paid at different times than their due date. So all of their bills may be due at the beginning of the month, and they need that second check in order to pay things on time. So the reason why that's there is if we need to contact those lenders and ask them, can they adjust your due date? Because they, they don't want you to be late. They do want to get paid. So in many cases, they'll be able to adjust your due date so that you won't be subjected to late fees and anything else having to do with that. And that's very important. So, that's why all of that information is included in this worksheet, so you can see that. And just to point out, these are just bills, loans that you have. So credit cards, auto loans, personal loans, and the like. Things like your utility bill, cell phone bill, you wouldn't put those on this form because those are those monthly expenses that you're paying anyway, unless you're in some sort of repayment that you have to put it here on this form. But otherwise, you would just put the credit cards and loans on this sheet.
So Jocelyn, 2 questions came in. One was, what is considered a good credit score? Like what, when you said no, what your credit score value can give you.
Yes.
And then the second question was, what is a target rate of paying down debt? Like what would be a good goal as a % of your total debt? You see people post things that may say like this, they paid down $200,000 in 18 months. Like, but what's really realistic?
Okay, so to answer the first question about credit score. So normally 650, 700 and above is considered good. So you want to target in that range. Credit scores can go as high as 850. So, just keep that in mind. If you have that 650 and above, you're considered good. But if you're 700 and above, that's even better. And the majority of your score, I don't have that slide, but I can pull it up. What really impacts your score is your payment history and how much debt you have. So those things are going to be, that's over 50% of your score is made up of those 2 items. And the rest is, your new credit, the type of credit. So, if you have a lot of revolving credit, like credit cards, those things aren't seen as favorably as, say, an auto loan or a mortgage. So you need to keep that in mind. And then your last question was in terms of, what's good. I tell people, a lot of times people will talk about how they, paid off their debt in, this period of time. That's what they did. So a lot of times you have to think of, all the time, you have to think of your personal situation as your own identity. So it's going to be unique to you. So try to kind of keep that noise quiet and that not impact you thinking that you're doing something wrong or you're never going to get there, because everyone's situation is different. So there are a number of ways, particularly when it comes to credit cards. You can look at paying down the highest interest rate first, because that's costing you the most. That's typically, as a financial advisor, what we say. But we know that we're dealing with people and emotions. Some people may say, you know what, I have a small balance. It may not be the highest interest rate, but I just want to get a win and pay it off. If that's going to motivate you to then, stick to whatever your repayment plan is, if you like it, I love it, because what I want you to do is win. And so I don't want you thinking, here I have the highest rate, which is also the highest balance, so I'm never going to pay it off. If that's going to give you that extra bump you need to keep going, do that. So, that's going to be important. But when it comes to repaying, whether it's credit card debt or any debt, that's why we started with cash flow. Because if you're already in the hole and you're overspending, it's going to be difficult. Where's the money going to come from to try and repay this debt off any faster? So it's going to start with your cash flow. Where can you cut expenses? A lot of times I have people look at, take 60, 90 days to look at where your money is going. So get your credit card statements, most of the banks, if we're dealing with it online, you can go through and get a report to see where your money is going. Are there, memberships, things that you're paying for that you're not utilizing? It might be a streaming service, although it's $9.99 a month, you might have 2 or 3 of them. So, and that all adds up at the end of the day. So see where you can cut some of those expenses, and then you can redirect that money into paying down your debt or going towards savings. Renegotiating, calling your cable provider, how can I reduce this bill? I know my mother just said, I need you to look at my bill. It's over $200. My mother watches probably 4 channels, and there's no way that she should be paying that much. Now, of course, that includes her internet and her phone, because she still has a landline, but still that's a lot for, a 77-year-old to be paying for that every month. So, really look at your bills and see where you can cut and, make some of those changes.
Or Jocelyn, there's a question in the chat. Is it a good idea to try to pay off your home when you're in your retiree phase?
To pay off your home?
Mm-hmm. Yes.
It really depends. For most people, for a lot of people, the goal is to have the house paid off before they retire, because that's probably one of their largest bills, because then that way, if you're not having any income coming in, that's going to be a huge savings in terms of monthly income. But again, it really depends on your situation. Will that cause a financial issue? If you, say take a lump sum and pay it off, you really have to look at it. So, if you kind of do all of your due diligence and that makes sense and is going to put you ahead, then, that may be the right thing to do. All right, so going on to the next item, and this is looking at risk management. So with risk management, this is basically what can happen that will throw off your ability to reach your financial goals. So these are all of the various insurances. And I know that this is sort of a topic that people don't like to talk about. Now, of course, when it comes to things like their auto insurance or homeowners, that's fine. We're quick to insure our stuff. So our car and our home. When it comes down to some of the other insurances at the end, that's where we really, in a lot of cases, particularly for Black folk, we are underinsured when it comes to life insurance and long-term care. So auto insurance, homeowners liability, this is to protect your stuff if something happens. Now, when it comes to health insurance and supplemental, we know that in our country, this is a big issue. The cost of medical insurance is, constantly rising above the rate of inflation. So we want to make sure that we have the proper insurance, that if in the event something happens, that we're adequately protected. For a lot of people, particularly for young folks, we know that with the ACA, it was changed. So, recent grads can stay on their parents' insurance until 26. So that's a benefit to make sure that they have that insurance. But I know that even for some of our dears, health insurance is a major expense, especially if you retire before you reach the age that you're eligible for Medicare, and you have that period of time where you're paying for insurance. So this is something important that you should talk with an insurance specialist to really make sure that you have the proper insurance that you need. And I've heard many insurance specialists, particularly those who deal with Medicare, say that a lot of times people, again, listen to what a friend or someone else is doing and think that that applies to them. Sit down, take the time to talk to someone about your particular situation so that you have the coverage that's most appropriate for you. And that may change as different medical issues come up. You may need, you may be taking prescriptions that you need to make sure that you're properly covered in that area, where the friend that you're talking to that's paying, the cheapest amount for their coverage may not be on the, the number of scripts that you are. So that's why I say that your finances are individual. It's like your own personal fingerprint. It's unique to you, and you need to make sure that you have someone looking at that, for your individual situation. Now, disability insurance is really important. And some people don't even think about that because, we all think, nothing's going to happen to us. We're healthy and we're going to, just be fine. But there are many cases where people get sick and are unable to work, and they don't have income to get them through until they're able to go back to work. So for instance, most people who work for larger employers, generally, this may be an employee benefit that you have. I've seen a lot of young people, particularly, who don't select the disability insurance because they think that they're invincible. But it's important because we have a higher probability, particularly when we're young, of being sick and unable to work versus a premature death. So we need to make sure that we have this coverage. So when it comes to just your overall employee benefits, look to see if your employer offers that coverage to you. And in some cases, they may even pay for it. So you want to make sure that you're selecting that when you do your open enrollment and, selecting your benefits. Long-term care insurance, this has become more and more of, an area of interest and concern, because as women, we live longer than men. And we know that the majority of the people in nursing homes and needing long-term care in nursing homes are women. So this is an area where we have to pay particular care to. This is insurance that's going to either help us age in place at home or go to a long-term care facility. So this is another area where your employer may offer this, not that they're going to pay for it, but they offer it at a group level. So it's not going to be as expensive as if you got your own policy. So these are things that we need to start looking at and not waiting until it's time to retire, but even prior to that. So you may have to look at this for your parents. So for the divas, we've heard of the sandwich generation. How many of us may be caring for our children as well as looking and caring after our parents? So this may be a conversation that you might have to have with your parents to look at what coverage do they have in place, that if something happened to them, how will you take care of them? Will you have to, self-fund some of their care where they have to move in with you? Or, might you have to put them in a long-term care facility? So these are important questions that you have to, make sure that you are having these conversations about. And the main thing, as we're talking about financial health, is really for us to get more comfortable talking about money and our finances. It should not be such a taboo topic that we feel that we're crossing the line if we're having money conversations. So we know that not much can happen in this world or in our lives without money. So we should not be, afraid or ashamed to talk about where we are. And the last is life insurance. And I can't tell you how many times that I've seen how it breaks my heart when I see GoFundMe's on social media when someone has a loved one pass away, to make sure that we have the proper coverage. You might not have enough to leave a legacy or an inheritance to someone, but having enough to make sure that you're not, leaving them with added debt or having to go into their own savings to pay for final expenses. And this is definitely a conversation that we need to have. No one really wants to talk about their own mortality, but we know that, one of the things that no one's getting out of here alive. So we know there's going to become a time when we will need life insurance. Of all of the insurances, this is the one that we know that we will one day have a claim for, where the others, we don't really want to have a claim. Those are just things to make us feel comfortable and, sleep well at night. But we know life insurance is going to have a claim eventually. And this is an important topic because people, are concerned about how much it costs, what type to have. And so having those conversations to make sure that you're properly insured is important regardless of age. So especially now with COVID, we've seen people of all ages pass away. So this is really important that we have these conversations. I see a hand raised, Soradana.
Hi, couple questions. One, with the life insurance, you should have should you have life insurance outside of your job? A lot of jobs offer it, but if you're out of that job, or then are you not going to lose that benefit? And should you go ahead and, as your child is young, try to get them life insurance so that their premium stays lower?
So to answer the first question, a lot of many employers offer coverage. So it might be $50,000 or some multiple of your income. To have that, that's fine to get there. But again, it's tied to your employment. And so I'm of the belief, God bless the child who has his own. So you have that insurance, but then have something that you owned, particularly for younger people who have, will likely change jobs multiple times. And so you don't want to be in a situation where you're in between jobs, something happens, God forbid, and you don't have any coverage. The same thing for older employees, because what happens is, and I've seen it in, talking to people who are looking to retire, and they're, we're sitting down and going over what they have. They say, oh, well, I have 2 times my salary at work. And I'm like, oh, okay. But you need to look at that, because what happens is when you retire, you're going to see that amount almost in some cases go to zero, or, get cut down to maybe $10,000, $20,000, not anything close to what you had while you were working there. So it's important that you read what's available, what that coverage is through your employer, to see if that's something that you can take with you when you leave, or if it's something that's going to be dramatically reduced when you retire. There are a few other hands raised.
I see Soror George.
Hi. So Jocelyn, I guess, what would you say, how much insurance should you get? I ask because I've heard stories of people's parents who was paying for life insurance for a number of years, and at the end it was maybe $5,000, $10,000, payout, but they had been paying for so many years. And so if they had just saved it, they would have had that money. So I guess, and so while we were having the conversation about having this conversation, it was one of the topics that we just thought, like, how do we kind of get people thinking about how much should I actually be paying for?
Sure. And that it depends on the situation, what you want this coverage to do. So I completely can relate to what you said. They had parents that were paying on it, and it might have turned out to be $5,000. So those were some of those old debit policies where the insurance agent came by and collected the cash. My grandmother had one of those, passed away, and had $5,000 of coverage. So those were older policies. I think in some areas in the South, they still sell them, but those, have gone away. So really what you want to do, and I can provide a worksheet that helps you think about how much insurance you should have. Again, what do you want it to do? Is it to just pay off your bills? Is it to leave money for loved ones if something happens to you? It really all depends on that, as well as what you can afford to pay. So, and then it's going to vary with the different types of insurance that there are. For someone who's young, term insurance is going to be the least expensive because you're young and likely healthy. So you would, pay the least amount. However, with term insurance, that's just for a term. So whether it's 5 years, 10 years, 30 years, once that term is over, that insurance, if you intend to keep it, is going to go up dramatically, and it's going to be based on your age at the time. So I was reading something that said in the insurance, more Black people, when it comes to insurance, may be open to having the cash value, or what may be whole life insurance that have built up that cash value, because that's also another way of, having the coverage, and then it's also somewhat of a, can be seen as a savings vehicle as well. So that the worksheet will help you determine how much you need. And then, you can look at what type makes the most sense. So for instance, if you're young, you're just starting out, you just purchased a home. You may have children, married. So you may just get a term policy for 30 years. That's how much your mortgage was, to cover that mortgage in the event something happened to you, so the house would be paid off for your family. That's, an example. If you're a business owner and you have debt or a loan that you took out, you may get a term policy for 5 or 10 years, whatever the period of the loan is, to cover that loan if something happened to you during that time period. So that's kind of how you start looking at what you want the insurance to be able to cover.
And sort of Jocelyn, before we go to the next hand, just on that point, someone asked to just reiterate term versus whole.
So it's term versus permanent, but when a lot of people hear permanent, they think whole life. There are different types, probably 4 or 5 different permanent insurances, but whole life is the one most people think about because that is what builds cash value. Term insurance is not building cash value. That's just, that's pure insurance. You're just paying for the probability that you pass away. So, that's something that you look at. And there have been cases where I have, you may recommend getting term insurance, particularly if you're young and, you're just starting out. So your cash flow might not afford you the ability to pay for the permanent insurance, but many of the term policies have what's called a conversion feature. And I know I'm probably getting too technical, where you can convert a portion or all of that death benefit that you have to permanent later without having to go through underwriting again. So, the benefit is when you're young and healthy, getting the insurance is less expensive, and then waiting till we're older and have different things happen where we may have to pay extra because we might have some health conditions that have come up.
So Jocelyn, this is a busy topic. We have one in the chat. It says, do the wealthy have life insurance or do they self-insure? And should it be a goal to self-insure?
So one thing that I would say, wealthy people use leverage. So they don't always use, they don't use their money for things. So life insurance, a way is to get coverage for pennies on the dollar. So when insurance first kind of, particularly here in the States, I know that there's some history with African Americans and slaves being insured, and slave masters given benefit when their slaves died or were killed in many cases. So there's a history around being skeptics of life insurance, but having that ability to use pennies on the dollar to get coverage is leverage. That's what people do. So to self-insure, that's, you're using all of your money. You may have been able to get that same amount by, paying a premium over the course of a period of time. So where it makes sense, then do the life insurance. I would suggest, looking at that as an option versus self-insuring. But some people may have to because they can't qualify for life insurance because of medical reasons. So, that's not unheard of for someone to self-insure. It's a lot harder because you're using your money, all of your money.
Soror Ebony Jones has her hand raised.
I apologize. I meant to take it down. I was going to ask Nashila, the question that Nashila asked and the answer that she received pretty much covered what I was going to ask. I just wanted to see about supplemental life insurance and how it covers certain debts, because I know I was told when I got my supplemental policy to make sure that it covered my student loans that have a cosigner. That way, if I pass before my cosigner does, they're not stuck with it. But I was going to ask about the mortgage and everything else, but you covered it. Thank you.
Thank you.
Okay.
Soror McCarthy Dennis.
Good evening. My question is with regard to prepayment. I've made pre-arrangements, I should say, for funeral arrangements, have made those arrangements, paid for them, have savings in terms of, personal savings, 401k investments and such to cover my home and any other bills I might have should I pass tomorrow. Do you still recommend life insurance at all, or is it advisable to do pre-arrangements? Do you see issues with that? I guess that's my question.
So, and you'll find that I say it depends a lot because it really depends on the person's situation. So I, shy away from making definitive blanket statements. So it depends, if you were to get life insurance, would you get it to, leave money for, loved ones or a charity? Some people, they get life insurance for that, not to pay off a debt, but to, leave money, leave a legacy. So that's one question I would ask. And then, two, looking at insurability, how much would it cost to get life insurance? Does that make financial sense to be able to, to do that? So those are just some things to think about as you look to see if, getting life insurance now is something that is a viable option for you.
There are a couple more hands. Soror Jenkins.
Good evening, Soror and Jocelyn. My comment is more of a comment instead of a question. I am a baby boomer.
Mhm.
And I've been through this term policy and whole life policy. I will say that when I purchased my term insurance, I was raising my children. So I more or less wanted to have a policy where if something happened to me, like my house would be paid off, or they would have some money to bury me, and then have a little bit for themselves, depending on what age did I pass away. Obviously, that didn't happen. I had that policy for 20 years, and I will say, like you said, the term policy didn't have any cash value for it. So I did at that time invested in a whole life, policy. Whereas if I was told by my insurance agent that insurance is for the living or for your loved ones, because obviously you don't need it anymore, but funeral expenses double every 8 years. So it also depends on, like you said, the age that, you're getting the policies. If you have any health problems, now you see commercials on TV all the time about you can get whole life insurance regardless of what age, up to pay, age 85. So I said all that to say that it all depends on where you are in your life. Like I said, the term life was good for me because I was raising my kids, and I was a single mother, at the time that they were young. They are millennials now. So, they're actually going through, my son is what I went through when I decided, to have kids. He's doing it because he has kids now, so I think it all depends on where you are in your life and what the need is. But you definitely need that life insurance. I call it burial insurance, so that I don't leave that expense for my children.
And to your point, Soror, when you talked about the person said that life insurance is for, your loved ones. So that is true in some cases, but also think about it. And when we're talking about kind of changing our mindset and having a wealth mentality, there are living benefits to some life insurance as well. So it is something that you could use for yourself now. Like, that's too technical to get into tonight, but I just want, for people to understand that there are some living benefits to life insurance too.
Last question, Soror Gardner Walker.
Thank you. I'm a little, I guess, confused in that it's my understanding that the more, as you approach, say, the deers scenario, let me say this in reverse. When you're a doll, that term life is a more appropriate thing because you're still in your earning years. And, I wrote that earlier chat comment about if you're in your earning years and you're investing appropriately, can you not build up substantial wealth with compound interest and things like that, such that insurance becomes a moot point? That's part of my question, because it sounds like there's a strong emphasis on purchasing insurance here, or at least life insurance and whole life policies as well. And I guess what I'm trying to discern is that I've been taught that that probably is the least of our issues, because if when you're young, you invest in a term life policy early on, and you supplement that with your proper investments, that your need to invest in a whole life policy becomes nil, because you will have accumulated sufficient wealth that you don't need it. I'd just like to hear your thoughts around that, Soror Jocelyn.
Sure. Again, I will go to, it depends. So for some people, it depends on how you do it. So that's the whole buy term, invest the difference. That's almost, if you are disciplined and you do that. There are some people who may not. It's, the same folks who get a tax refund and say, oh, well, I'll save it. And then when it comes time, they spend it. So, it really depends on how disciplined you are to do that. That might be the case. And please, I hope no one is taking from this that I'm emphasizing, either life insurance or whole life insurance. I'm just talking about risk management in general, and those things that we need to be mindful of that can kind of take us off our square. If it happens, that can derail us from reaching our financial goals. And so insurance is, kind of where that comes in. And if you don't do it, then of course you would have to self-insure. So, by getting insurance, even whole life or permanent insurance when you're young, is not necessarily a bad thing. Because at the end of the day, if you find that as you get older, you have substantial assets and you don't need it, if it's a cash value policy, then you can surrender that policy and take that cash value. So it's about having options, and a mix of options that you can go to accumulate wealth as well as protect yourself and your family. Are there any other?
Since it was my question, I'll just ask you I'm just going to probe a little further, because perhaps this is just an opinion, but I think as Black people, because we're not as informed, we tend to go in that direction because we don't understand the time value of money and so forth. And we rely heavily on things like insurance policies and so forth versus systematic savings and investments that would propel us into more like living like the lifestyle of the wealthy. And I guess there's a part of me that kind of feels that, particularly one of my takeaways from this workshop is that how, and I'm thinking more like if I were a doll, and I am not, but how can I situate myself in such a way that these are not issues that I have to contend with? And I guess I'm looking for the real deal. Help me understand the time value of money and how I can invest and grow my money like rich, I'm going to say it, I'm going to go all the way there, like rich white people do. And then they don't rely on these kinds of things.
So,
Jocelyn, I think that could probably be a whole.
It is, and I'll just say quickly, and then we can, move on to the rest for the sake of time. But understand that rich people, regardless of color, they have insurance, because if you're rich, there's this thing called estate taxes or taxes. So they use life insurance to pay for some of those taxes so that what they've accumulated goes to who they want to. So these are strategies that are utilized by rich people. That's the reason why insurance was created in the first place, to help those who were rich. So again, the whole purpose is for us to to know what all of the different strategies and options that are available. So there, we are not just going to one thing, that we know what's out there. So, you know, rich people are using insurance in various ways.
Yeah. And I want to be mindful of time. We got 20 more minutes left.
Okay. All right. And I'll move quickly.
and probably a lot more topics, but yeah, Jocelyn and I spoke as we talked about this presentation. Any one of these topics we could have spent 90 minutes on. So this is meant to be high level and enough of a way to get our thinking caps on, and to then reach out to our individual, you know, financial consultants.
Okay, so the next is talking about wealth building, and under here it does have home ownership, but that is not the only way to build wealth. And the reason why it says home ownership is for, in large part, for most people, their home is where they're accumulating or building wealth. And so they are mindful of that. Some statistics as we talk and look at the wealth gap, particularly in the Black community, there's been a lot of attention, while it's existed for forever, there's been a lot of attention around the wealth gap over the last 2 years with a lot of the social unrest that we've experienced during COVID. So this is information that talks about what the wealth gap is. So if you see for a white household, the median wealth is a little over almost $190,000, where for a Black family, it's just a little over 24,000. So Hispanic, they're a little over 36. So that gap is significant. And one thing that I always point out is that we know that income is not wealth. So while many of us are, we are making strides in terms of professionally and making a lot more money, that still we may be earning, high six figures or whatever, but that is not the same thing as having wealth. So that's important to point out. And again, while I mention the home ownership rate is, it's important to know because, and I'll just read this, in 2019, the Federal Reserve issued a report stating that homeowners had a median net worth of $255,000, whereas renters, on the other hand, had a median net worth of $6,500. So that difference is significant, particularly as we look at the home ownership rates of Blacks relative to the national average and white. So the results of the 2020 census said that we had home ownership rates of about 46%, where the average was 66. And we, you can do a lot with the equity that you build up in your home. So whether that's using that leverage to pay for a child's education, start a business, do different things, there are some advantages to that. But I will also say that, buying a home is not for everyone. So it depends on your situation. If you're someone who travels, who moves a lot, buying a home may not be for you. So you have to see what makes sense for you and your personal situation. So this isn't the go-to for everyone. And we know that a lot of our young sisters see home ownership as because they lived through the Great Recession and maybe saw their family or people that they know lose their homes. This is not an easy topic for them to look at because there is some, negative feelings associated with being a homeowner. So, again, we're looking at options, ways that we can, build wealth as well as leverage the equity in our homes to be able to do other things for ourselves. Sorry. The other thing that, I apologize for that, my computer just went crazy, that we're looking at here. Sorry, 1 second. I'm just going to stop share for 1 second and go back because my computer just did something very weird. Can you see my screen?
What are you trying to do, Sir Jocelyn?
Do you see the PowerPoint, or I'm trying to see what you actually see?
We see the slide sorter, so you
You see
might
this?
need to.
Okay, hold on, I'm gonna stop sharing again. My apologies, I don't know what happened here. I might have to close it and go back in. Okay. Okay, all right, so you can see the net worth statement?
Yes.
Okay, all right. Again, my apologies for that. So as we're talking about wealth building, this is where we see what wealth we actually have. So again, it's not our income, but what we actually have in terms of wealth. So that is our assets minus our liabilities, and looking at what those assets are. You see the categories that are listed on the net worth statement, and then what our liabilities are. In many cases, as we talked about the wealth gap, as African Americans, we have less wealth, and particularly as Black women, we have less wealth than our peers. So it's important that we are looking at not only where we're spending our money, but what we're doing to accumulate our wealth, to make sure that we're in a position to constantly grow it. So I see the net worth statement as almost like your financial report card. As you can see at the top, it has as of, so you put a date. This number is going to fluctuate and change. Ideally, you want this number to increase every year. So, look at it at least once a year, whether it's at the beginning of the year. I know that some people will take a look at it even around their birthday, that's their own personal new year, but look at what your personal financial position is. And it's important that we know this and continue to build this, and having conversations with with our loved ones about, not necessarily telling them what you have, but, being able to have conversations about building wealth and our net worth with other people that we trust. This slide, I just want to talk about, this is sort of one of the highlights of sort of what's been happening over the last 2 years, as well as the changes in technology. So this comes from Ariel Investments and Charles Schwab. They do an annual Black investor survey. So something that they found in the survey from last year is that Black Americans under the age of 40 were investing at the same rate as white Americans. And this is a very positive sign, particularly because, again, getting out of, being risk averse. We talk about women, but that's also something that's said about Black Americans, that we don't like to take risk and invest. So seeing that more young people are open to investing is certainly a positive sign, because now there are things, you can invest just on your app. You can, buy smaller shares if you can't buy a whole share of something. Charles Schwab has something called slices, so you can buy a portion of a share. So there are so many more ways that we can invest than we could just, 5-10 years ago. So this is really important. But at the same time, it's important that we know that we're not investing money that should be in our savings account. A lot of times people will, have a tax refund or something and want to invest the money. And I have to tell them, well, let's take a look at, do you have adequate savings? Do you have consumer debt that might be high interest? So, you want to make sure that you're investing money that you not looking at that as also your savings account, because you may need it at a time when the market is down and you might take a loss. So all of these things, you have to make sure you're putting your money in the proper buckets. Next, and I'm going to move through quickly, LaShawn, please just let me know time-wise, is talking about retirement planning. Now, we're not going to have a conversation about investing, but just about retirement planning is important, because we need to make sure that we are not only taking care of what we need to today, but planning for the future. So finding that balance between taking care of now, but also looking at the future. And so retirement, there are a number of different vehicles that you can have in place to cover your retirement. And we use this symbol, sort of the broken three-legged stool, because retirement is very different than it was before. So there are companies don't have pensions like they used to. So most young people, you know, our dolls are not necessarily going to go to employers that provide a pension. They're going to have to save the bulk of what they need and invest for themselves, either in a 401k or 403b, whatever retirement plan their company offers, or if they're self-employed, you know, putting money aside in a retirement account for themselves. So there's been talk about, you know, the viability of Social Security, what that looks like. And we know that people are not saving enough to be able to, you know, sustain their standard of living, or their, you know, their current standard of living for retirement. That's why it's seen as that broken, you know, unstable. And we know that there are many people who are, you know, 60 and older, who are still working because they have not saved enough, or they need to work in order to pay for medical insurance. So it's very different than, you know, working for the same employer, retiring, getting your pension and the gold watch, and, you know, collecting your monthly pension check. That's not the same now for majority of the Gen X, Gen Z, and millennials. It's in a totally different situation. So it's really important that we stress putting money aside early, because your greatest asset is having the time for your money to grow that you've invested. And so even if you're saying, you know, I don't plan to be at this job for very long, still put money away, because that money is always yours. And if your employer matches a percentage that you put away, even better. Now, again, if you don't stay there long enough, you might not get the full amount. But remember, whatever you put in is still always yours to take and, you know, move to the next employer. So starting out and doing it early is really important, because time is your greatest asset.
So Jocelyn, question came through that said, which is better or most common for retirement while young, Roth or traditional?
So the reason why you would do a Roth is because Roth you're putting away after tax dollars. So these are dollars that you've already paid taxes on. So if you think that your retirement tax rate will be higher, then you would do the Roth. You would do the Roth now, because when you take the money out, you don't have to pay taxes on it. So a traditional account, you're getting the tax deduction now for the money that you set aside. And when it comes time to take the money out, you have to pay taxes on it. So, you know, it depends on what you think your, you know, what retirement will look like. And now there are more companies in your 401k or 403b who offer a Roth as an option. So it's not doing either or. You may be able to put some in a Roth and some in the traditional retirement account. So it really depends. Do you need the tax deduction now? You know, it depends on your situation. But a lot of young people will do the Roth simply because, you know, you're thinking, I'm just starting out. I know that, you know, as I go through my career, my income should be increasing. To put this money aside now in the Roth would make sense. And you can always, you know, switch to a traditional later. See, there are two other hands raised.
Hi, this is Soror Donna. Just a statement, you know, this is fantastic, because I really have a hard time trying to get my employees, especially the younger ones, to put away money in their retirement. And even when they say they don't know where to start, I mean, I'm not a financial advisor, but my suggestion is to take a percentage, because they're not avidly looking at it. So when you get a raise, you automatically increase what you put into your savings in your retirement plan.
Right. What I tell people to start out, Soror, is, you know, there are some plans that do automatic investing because they know particularly young people are not going to, put money aside. But, start with a smaller amount, an amount that you don't notice coming out of your paycheck, and, gradually increase it until you see it, may have an impact on your cash flow for that period. And then as your salary increases, keep increasing the amount that you set aside. One thing to point out is the maximum that you can put into your 401k or 403b. I think it's 20,000, might be 20,500. I can't remember exactly the number. So that amount, depending on your income, is just a small percentage of what you're making. So, as we talk about what the gap is in terms of retirement savings, we still need to do more, even, may need to do more even beyond that, our company retirement plans that we're putting aside for our retirement.
And so Jocelyn, we have one more hand, and it's almost been 90 minutes.
Okay.
And I know if I think about that chart,
Yeah.
We still didn't hit on like.
Well, I'm going to jump to the estate planning piece.
Okay. Was that the last piece, you think?
No, I had tax planning, but that's just a quick, I can do that one in like a minute.
Yeah. So we have one more question but I think we may have, and technology, keep me honest here, we may have a hard stop.
Okay.
At 8 o'clock, is that right?
All right.
And so if there are questions that you want to have answered that is related to these next two topics, put them in the chat. We'll capture them and we'll circle back and we'll get you the answers in addition to the worksheets that were presented.
Okay. All right. So I'll just jump to tax planning. Here is, we all know that we have to pay Uncle Sam. That's, they say one of the certains in life. So what we want to make sure is that you're not paying more taxes than you need to. And in many cases, you may be in a situation where you get a tax refund every year. Again, that is a tax-free loan to Uncle Sam that you don't get any interest on. So maybe it may make sense to adjust your withholdings to get more of that money throughout the year. That may help you cash flow wise. So keep that in mind. If you're constantly getting a tax refund, and some people are disciplined, they use that, put it into savings or to pay off debt, but other people use that to, will spend that. So again, looking at your money personality to see if this may work for you. And then lastly, I'm going to just, spend until you shut it down, is talking about estate planning and, just looking at a legacy. This is another area where historically we have been, kind of slow to get it together because, who wants to talk about our own mortality and death. But this is really where we need to be more mindful. They may think that doing estate planning or legacy planning is only for the wealthy. It is not, particularly as you look at some of the other things that are involved here. So, having a will is, where you're saying what you want to have happen when you're no longer here, who gets what. So, that is something that you want to have in place. Equally important is having a living will and medical directives. If you are unable to speak for yourself, what do you want to have happen? Do you want to be kept on life support? Do you want blood transfusions? Do you, want all of, take whatever, exploratory, drugs or procedures might be available to keep me alive? Do you want that? But this is you telling your loved ones and what you want to happen. Powers of attorney. There could be a medical power of attorney. You appoint someone to make those medical decisions if you're unable to. There are, you also have power of attorney to handle your financial affairs. If you are unable to, take care of your finances, your power of attorney can come in, make sure your bills are paid. Those things are in place. HIPAA disclosures. I point this out for a number of reasons. For parents who have children in college who are considered adults in the eyes of the law, You know, when they go to school, if something, God forbid, happened to them and they had to go to the hospital, if you don't have the proper HIPAA disclosures, you go to that hospital, they're not going to give you any information. Same thing for couples, or, you know, even single people. Who might you want to, you know, have the ability to get this information if something happens to you? These are all part of, you know, estate planning and legacy planning, or even to not make it seem so high level, like you have to be wealthy to do it. This is more just, you know, stuff planning. We all have stuff. So making sure we do that. The personal property memorandum are, you know, what do we want to happen to, you know, our jewelry, certain, you know, things that have significant personal value that you want to make sure is done. I have heard horror stories of families arguing. Mom or dad passes away and the children are arguing over, you know, mom's X, whether it's her wedding ring, her Bible, her whatever, things that have more sentimental value than actual financial value. But this is important, you know, to have this memorandum to say what you want to have happen to those things, or even give it away while you're living. If you want to do that, that will eliminate, could eliminate some family stress that comes along. Having your ethical will and legacy documents, you know, not just passing on assets, but, you know, what are family, you know, kind of what the family, you know, what your beliefs are, those things, passing those things down to your family as well. And then lastly, I want to point out online accounts and social media. Many of us have online accounts, whether it's Facebook, Twitter, Instagram, whatever, but you have things there. There are photographs, all of that. Now you are able to, you know, set up, if something happens to you, what happens to those accounts? Does it come down, you know, or, you know, can you go in and get those photos? All of that. So these are things that you have to make sure that you have in place. I really stress, you know, it's important for everyone, but for younger people, single people, having your living will and those things are really important, regardless of age. And when you do that, let people know where these items are. Either the attorney that you did them with, if they're in a safe or somewhere at home, a safe deposit box, let them know. I've heard stories of people, you know, passing away and their family members knew that they had a will, but couldn't find one. So that's the equivalent of you not having one. So you do have to tell your loved ones, you know, where it is and how they can access it. You know, whether you give a copy to whoever you identified it as your executor, those are things. And then if you update it, you know, making sure that you make those changes as well. Also important to note, things that do not go through your will. So your 401k and life insurance, those items that have their own beneficiary designation, that is how those things will pass. So if you've gotten divorced or any of those things, and you had your ex-spouse or former spouse, it's still going to go to them if you have that beneficiary form for your life insurance or your pension still set to that person, regardless of what your will says. So that's always important to keep in mind. I also caution parents who designate their minor children as beneficiaries, because minors cannot inherit assets. So if something happens to you while they are still minors, that money, or, you know, whatever that property is, will have to wait until they are the age of majority, whether that's 18 or 21, depending on the state. So, you know, and know that when you do a will, you can always update it and make changes. There are services in place to provide, you know, free wills for our dears, or for people who are, you know, for people depending on what your income is, so that there are options. This does not have to be a very expensive thing to do, but it's definitely something that we need to, you know, make sure that we have our house in order for our family and our loved ones. And I'll end it there.
So Jocelyn, who would someone go to, quick question, who would someone go to for all of that? Is that a financial planner, an attorney?
You would go to an estate attorney. And so, you know, there are the bar association. You can contact your local bar association, because attorneys do pro bono work as part of their, you know, community service. And so find out if there is, you know, who provides free or low cost estate planning in your area. Then, you know, that's something that you can look at as well. But you would want to have an estate attorney do these things for you.
Any,
Jocelyn, there was one question in the chat earlier.
Okay.
It was on one of your earlier topics, so we have a couple minutes. Let me ask the question. What do you
Okay.
think about paying all bills on your credit card and then paying the credit card off at the end of the month?
If you are disciplined enough to do that, and don't, you know, you don't get into debt or trouble with that, do that, because, you know, it might be a credit card where you earn points and you use those points for vacations or other things. So if that works for you, that's great. And I know people who, you know, who do that, you know, put everything on their credit card and then pay it off at the end of the month to be able to accumulate those points.
Thank you, Soror Karen. That was actually me, Alicia, and thank you for answering, Jocelyn. That was what I was alluding to, is the points, and then also the debt to income ratio for your credit score. So, you know, as you pay credit cards off, your limit increases, and it helps your debt to income ratio, which increases your points for your credit score. So that's what I was getting to.
Right. And you know, also to your point, sort of, that you said that, you know, these credit card companies, it's like kind of the carrot that they put there, increasing that credit score. They, you know, figure that if they give you more, you'll spend more. So be cautious of that, you know, that you don't get into trouble and being lured in by that higher credit score, because they'll just, you know, send you that note. Oh, you know, you've been a great customer. We're increasing your credit limit. If you think it's too much and might be too tempting, you can always ask them to adjust that. It's important that you know yourself and what might be those triggers to have you, you know, spend outside of what you should comfortably be doing.
Thank you.
Sure. All right, so I'm going to, I know we're kind of right up at the hour, so I'll just leave it with this African proverb that says, when you educate a man, you educate an individual, but when you educate a woman, you educate a generation. We are known for, you know, we are the caregivers. We take information back and share it with others. So I hope that this information has been helpful. I know we were, you know, covering a lot in a short period of time, but I hope that it has been helpful to you. I will provide the worksheets to LaShawn to give to you. I think it was the cash flow worksheet, the debt worksheet, and the life insurance worksheet that I will provide to her. And the
we do have a little bit more time, Jocelyn. We were able to, we do have some time, although I know it's at the top of the hour.
Okay.
And wanted to make sure, since we have Sorors engaged and you have the Q&A up, I saw 2 more questions in the chat. Soror George has her hand up, and if that's it, that might be all we have. So just 3 more questions. And then I will wrap up with a reminder of our savings challenge. So the first question that came up a while ago was just around, I'm trying to, there was asking about the role of the executor.
Mm-hmm.
That was one question. And then is it okay to insure minors and children?
So in terms of the role of the executor is who you appoint that upon your passing, that they will see that your wishes that were laid out in your will are executed. So, you know, this could be, you know, your spouse, a close friend, you know, someone that you know that will, you know, make sure that your wishes are done according to your will. And same thing with that it can change. Say you designate someone who was a good friend, you may have a falling out. You can update it and change it. These things are not set in stone unless you're doing something that's irrevocable, meaning that you can't change it. But, you know, these are things that can change as our life circumstances and situations change as well. And insuring children, you certainly, that's something that you can do. And so if you work for an employer that provides life insurance, in many cases, you can get coverage for your minor children at, very low cost. And I encourage parents to do that because we just know that, we've seen tragic stories of young people, passing away for various reasons. So to make sure that you have that coverage in place, then, you can get it at a very, very inexpensive rate.
Thank you. And then last but not least, Soror George.
Yes, I was gonna ask, I think my question was, back when we were talking about retirement, and I know you covered off a little bit about the Roth versus traditional. In terms of if I am preparing for retirement or in retirement, what's the view on the mix of types of investments that I should have? I know that even in our chapter, when COVID hit, clearly the market bottomed out. A lot of people who were holding a lot of stock from their employer, saw that stock reduce significantly, which meant it was also impacting their retirement and their income, right? Their pension or whatever coming out of their account. And so one of the discussions that we were having then was, if you're in retirement, maybe you shouldn't be so heavy in stocks at this point. But I wasn't sure, just from a financial perspective, is that right? Or what can you tell us about what we should be looking at in terms of investments?
Sure. So again, I will start with it depends. But what I will say is, for each person, the amount of risk you're willing to take is going to be different. So in general, for someone who is in retirement, you would not necessarily have, and this is again, generally speaking, 100% invested in stock. You would, but you still should have some invested in stock or growth, because you're not going to need all of your money right now. Your retirement could be 20, 30 years, depending on how long you live. So you need to have that growth component for your account value to continue to grow as you, start taking withdrawals from it. So, we've heard some people say, if you just did, it could be 70-30. You have 30% in stock, 70% in fixed income or bonds. But it can also be higher. You might just do 50-50. It really all depends on what your appetite is for risk. But you do need to have some component of, you should have some component of growing, because some people are in retirement for almost as long as they were working.
Thank you.
Mm-hmm.
Any other questions? Again, if you think of anything once we hang up, feel free to shoot me a note. Soror Jocelyn, thank you.
You're welcome.
I've gotten a lot of messages already. Great session, very informative. This was awesome. So
I know it was a lot of information, kind of just
it was
thrown at you. So hopefully it wasn't.
It was some clapping of the hands. And so thank you again for us in this casual workshop. Soror's reminder, this is the kickoff to our Financial Fortitude Challenge. So hopefully, if anything, even if you don't participate in a challenge, the Economic Development Committee, Delta as a whole, right? Economic development is a thrust. We encourage you to, take something away based on, it depends, right? Based on your individual needs. And we hope this was a valuable time, spent on a Wednesday evening. So again, reminder, we will be sending out the details of the Financial Fortitude Challenge. There is incentive to participate and to earn the most points. And we're going to also donate this. Our activity will also be felt by a local nonprofit, Stand By Me, who focuses on financial literacy. And then there's going to be more. There's going to be more in April, where we'll be inviting the community as well as our youth participants to kind of join in a similar discussion, topics related to the need of that audience as well. So thank you so much, Jocelyn. Thank you so much, Sorors. Information will be forthcoming. Have a great evening. Thank you.
Take care.
Thank you. This was lovely.